All right, good morning, everyone. Thanks so much for joining us. My name is Albert Marquez. I'm joined by my friend and colleague, Mr. Constantine Randopoulos, and we are part of the Trading Strategy Desk. We're a small group of market technicians and traders whose goal is to educate and hopefully facilitate your trading process. Welcome into the morning market briefing here for Thursday, the 17th of July. Hard to believe we're halfway through July already, but here we are. A lot of things going on under the hood here, Constantine, right? We've got a lot of things that are carrying over from yesterday, some big impacts from some Fed related stuff, which I'll get into. Earnings, we're deep into the earnings season, or at least getting started on the earnings season, I should say, as we still have a lot to go. We just started on Tuesday. And of course, we've got data as well, right? And plenty more things to come here for the rest of today and certainly tomorrow as well. But before we jump into all that, Constantine, how you doing this morning? Great to see you.
Hey Albert, thanks so much for being here, everybody. Great introduction there, Albert. It's great to see you back. I know you had a decent amount of time off to spend with your family outdoors. I hope you had the ability to sort of refresh your powers, sir, because we certainly do need you for sure, especially given the current environment, given the headline news driven type market. Plenty to discuss. I can't wait to hear your thoughts on what's going on there on the Fed front. Let's get into it, Rob.
Yeah, I've definitely got some thoughts on that, and certainly that is going to be a key focus for the markets. It certainly was yesterday, and you know, bottom line is this, right? It's not over. There's going to be more to come. But before we do that, let's just jump in real quick and take a look at some of the data that we did see this morning. As always, a good place to start. Jobless claims coming down, right? That was a really good number, 221. We've been seeing 240s recently, and now we're back into the 220 handle. So that's always a good sign. Nothing here that's going to cause any alarms. If anything, it just kind of takes pressure off the Fed situation, right? Going back to the rest of the calendar, the other one we had that was a big one for me was retail sales. This is a big beat. Now, I haven't had a chance to dig into the ins and outs. I'm sure there's some nuances within this number, but here's the bottom line. This number, combined with that jobless claims, there's not a lot really to support the rate cut narrative at this point in time, and that's really going to be the key here, and that's really what the market is looking at right now with regards to where are things headed. Now, again, that's always has ability to change, but the bottom line is if the consumer is still out there spending, even if they're pulling back on certain things, right? If they're not maybe going out to dinner as much and things like that, but they're still spending money. That is obviously something that we're going to be keeping an eye on. In fact, we saw that with the previous inflation reports. So services were a bit down. I'm sorry, good prices were up, but service prices were down. So we'll see how that continues to shake out. But bottom line is this: based on what we saw this morning, really not a lot here to support a rate cut narrative. Philly Fed, I don't even know why they give this a star, Constantine. This thing is so wacky. It's 15.9 when they're looking for negative zero point 0.4. This thing we never paid attention to. It's just too noisy. But it is what it is. I suppose we can take it as a good report. I wouldn't pay much attention to it. I would say that a couple of things coming up later in the day to keep an eye on. Obviously, Adriana Kugler, I would always pay attention to her. She's the Federal Reserve board member and a voter, of course. So that's come. I think that's actually happening right now. Also, later in the day, the one I really think is going to be important. Well, we got Mary Daly. She's not a voter, but always an important voice to listen to. Lisa Cook is a voter, but this is the one I would point out to you. This is going to be happening after the markets. Obviously, we all know that if we're looking at the Fed and we're thinking about who's where, we know that there are two people that are currently on the opposite side of the boat from everybody else, and that's Waller and Michelle Bowman. So I would certainly pay attention whenever you see Christopher Waller's name pop up. This might be a good one to sit down with a favorite beverage and just kind of follow along what he has to say, because I'm sure the market will talk about this one tomorrow. So just be aware of that. Speaking of the Fed, right? We had obviously the big story yesterday was a continued talk about the president and continued pressure on Powell. We saw it, in fact, if I go back to the Dollar. This is the one that you can really see it in the dollar, and I'll go back to 2 days just so we can get a good perspective here. But right here, right, this is where everything kind of started to move, and this is the dollar is the one we need to keep an eye on because that's going to be the real indicator of what the market thinks of all this stuff. But it was a response to reports that the president asked a group of lawmakers about firing Jay Powell. And again, he had a press conference there, and you know, we had a little bit of a rebound after he insisted it was highly unlikely it would fire him. You know, the background, of course, is that the president wants Powell to cut rates by as much as 3%, which is, you can have your own opinion. It doesn't really matter, and I have mine, but that's a lot, right? Getting us down to 1 to 1.25, that would be a tremendous move. Not happy that the Fed is cautious due to tariffs, and yesterday, of course, the last few days lashing out. Yesterday, again with the name calling, numbskull, I think was the word he used yesterday. It's again another reason why I can never do Jerome Powell's job. That's not how we do things on the trading floor. I can tell you that we don't deal with them. We deal with them a little bit differently, but they're trying to currently backdoor him with this renovation project. So I kind of looked into this a little bit, and this is the new focus, right? The Supreme Court already ruled you can't fire him, but you can still fire him for cause. So now they're saying that the $2.5 billion renovation was over budget. Powell said, that's inaccurate. In fact, many features were scrapped. Another front was that it had been approved by the National Capital Planning Commission back in 2021. So now they're arguing that those changes need to be reapproved. But Powell's like, hey, listen, we don't even have to comply with the National Capital Planning Commission. We just did it, as a courtesy. But essentially, what it comes down to is this. They're basically accusing Powell of overspending and also acting unethically by scaling back project to save money without approval. So it's an odd situation. I don't think it's got legs. But again, we'll see how this kind of plays out. That's really what they're using right now to say that potentially you could fire him. Because remember, you can only fire Jerome Powell for cause at this point. And that's what they're saying, gross mismanagement of project. Now, that did come yesterday with some support for current policy. John Williams, who is the New York Fed president and a voter, of course, he said, he was reluctant to support lowering rates. He believes tariffs will increase inflation by about 1% by early 2026. So now we're talking the next 6 months, essentially. He said data already showing price pressures in consumer goods. He said for items that are more exposed to higher tariffs, price increases so far this year have been well above what one would expect based on past trends. We talked about this Tuesday. We talked about the fact that, yeah, the CPI was, appeared to be okay, but if you look under the hood, we saw that certain things like appliances were higher. In fact, he cited appliances. He cited, I think it was musical instruments and luggage in his speech. But he said that maintaining this modestly restrictive stance of monetary policy is entirely appropriate. As for the ongoing political pressure, he said, the Fed's going to tune it out. We have a job to do. And I think this is an important thing because again, I mentioned this before. When you talk about the Fed and you talk about Jerome Powell, he's one guy out of 12, right? And you've got 12 people that are voting on this policy. So even if you put in somebody to replace Powell who was in favor of cutting rates, that's only 3 of the 12. The 9 other are not saying that type of information. So to me, this whole idea of replacing Powell is sure you could do that, but at this point in time, the majority of that board is saying we don't need to make any moves currently. So I don't know that that's really going to get the effect that you want. We also heard from another supporter, Jamie Dimon, supporting Fed independence. He said, I think the independence of the Fed is absolutely critical. He said, playing around with the Fed can have adverse consequences, the absolute opposite of what you might be hoping for. And what I think he's talking about here is the fact that even if you get Powell out and you place a yes man in there, that's going to affect long-term rates because the rates are going to move higher based on the fact that they're thinking that the Fed's not going to be independent and that it might have a problem with inflation in the future. And that's what he's talking about. And that's certainly something that the administration is trying to avoid is these higher long-end rates. Now, remember, also Jamie Dimon was the first one that kind of spoke out after Liberation Day. He said he basically warned the president that he was risking a recession, and it was a message he eventually heeded. So we'll see how this plays out. But this is certainly a focus right now. Once again, as I would say, the immediate concern passes, right? But again, as I said before, Constantine, this is not the last word on this. In fact, if we take a look at the Fed Watch, again, this third-party source from the CME group, you can see that for the July meeting, we're priced in at almost 98% chance of keeping things where they are. In fact, if we go to the aggregated as well, you will notice that we're only fully priced in for one rate cut by the year end. And in fact, we're 50-50, almost 50-50 for September. This is going to be this is going to be an interesting end of the year if that actually plays out the way it is. And the pressure, of course, will build in a couple of weeks when this Fed meeting happens. So we'll see if we reignite the flames of malfeasance, so to speak, for Powell and trying to get him out. But it's going to be an interesting few weeks going forward with regards to, excuse me, an interesting few months going forward to determine how this is going to play out. Because I can tell you right now, this is definitely not what that administration has in mind. If you take a look at the SOFR, of course, the one I prefer to take a look at, you can still see we're here at September and December. I think probably what you're seeing is this December one is probably fluctuating back and forth between the end of the year and next year. So that kind of makes it similar to what the Fed Watch is seeing. But again, only fully priced in at this point for one rate cut going into the end of the year. And the effects of all this, we see, the market's responding with concern. And let me pull up the 10-year here because this is where we're seeing a lot of the action is in rates. And if we take a look at what's been happening recently, we have a situation where we had this kind of flag pattern, right? Moving back down towards 4.25%. But here you can see we've been breaking back out. And now again, here we are with the fact that we are at the getting close to that 4.5%. And also we can see this in another avenue as well. Let me pull this one up as well. Pressure to lower rates is pushing up long-term inflation expectations. This is a 10-year break even. It essentially looks at 10-year yields and 10-year tips and what the market expects inflation to be in the next 10 years on average. These are levels we haven't seen since February. Okay, so the market is obviously concerned, more concerned about that Fed independence, as I said. If the Fed bends to the will of the president, the assumption is that the new Fed chair will be a yes man and could have trouble curbing inflation. So again, that's kind of the issue that we're dealing with right now. If you go back to that 10-year, not quite as high as the beginning of the year, but still certainly moving towards that 4.5%. Taking a look at the 30-year, that's a slightly different situation here. As you can see, was over 5%, and really higher than the beginning of the year as well. Back to the highs of May, we had this is back when we had that poor 20-year auction, if you remember. And then there were concerns about the actual bill, the effects on the deficit. And now here we are again trying to plumb those levels of 5%. So the treasury market, the interest rate market, these are going to be things that we want to keep an eye on. Historically, that 4.5% in the 10 years has been problematic for equities. And certainly 5% is an eyebrow raiser in the 30 year as well. So we will see if these continue to stay at these levels. And if they do, maybe we get some situations with regards to equities, but we'll have to see how these things play out. But certainly that's the things that I'm definitely keeping an eye on right now, Constantine, with regards to where we are and where things are headed. But again, a story that probably is not finished yet and will continue to unfold over the coming weeks and months. But keep your eyes on these types of situations. And as I said, pay attention to Waller tonight. I think that's going to be an important one.
Albert, uh, great observations, obviously, amazing analysis. Very much respect your views and opinions. You've been in the business a long time, so it's great to hear your thoughts on this front. I just have to say, Jerome Powell obviously has been at the Fed for the past 8 years. Well, let's call it 7.5 plus. And he's been a man who was able to kind of drive the overarching consensus at the committee very well. I mean, there hardly have been any dissents, and you could correct me if I'm wrong here, Albert, but I would assume from my personal memory, I think there might have been one or two meetings where there were dissents. Other than that, they were kind of all voting together in tandem. So whoever it's going to be, I mean, we know for a fact we're going to get a new chair next year in the month of May. Whether it happens prior to that is to be seen. But we have to remember, Albert, to your point, there's a committee and everyone has to vote, and everyone's vote is equally weighted. So it doesn't really matter if you're a chair If you're a voting member, you have an equal vote. So an important caveat there. Let's get on with it here, Albert. We have the market opening up in just a few seconds. I have plenty to share, slightly more kind of tactical, technical stuff for the folks. I usually share the trading strategy desk schedule for everybody. The X's are the sessions that I usually present in. A reminder for everyone, and the reason why I do that is because people have asked for it. Some might not want to be there, others do. So we are obviously in the morning market briefing, and we got a full agenda today. Uh, Mr. Robert Kwan, a friend of ours, of course, on the desk, wanted us to remind everybody that he is running the show at 6 o'clock Eastern today for charting extravaganza. So that should be interesting. A few things on the technical front here, Albert, as we're kicking off the session. I'll talk about some of the pre-market movers. I did a little bit of analysis here in the S&Ps. Just a reminder, we are going into the options monthly expiration week. We had the VIX monthly expiration cycle yesterday. I talked about that at length in the volatility primer. Today, when I was creating this chart, the S&P pre-market was trading at 6270. We were able to get a little bit above that, but pulled back towards the open. And so just shy of 6270 we sit as we're speaking right now. What are the lines on the chart, folks? These are the levels that we ought to be paying attention to from the options expected move dynamics. Believe it or not, realized volatility of short-term activity in the S&P 500 has been on the absolute floor. I keep calling it 1.5 step forward, 1 step backward type action. There's really not a whole lot going on. We've been lulled into a very dull type of a market, even though intraday, on the close to close basis, that is, because that's the way we evaluate realized volatility on close to close basis. But intraday, plenty of excitement, to say the least. We had a big opening a couple of days ago. That would have been Tuesday. We topped at around 6,300 yesterday, of course. On those Jay Powell news, we bottomed at around 6,200. That's a 100-point range, but overall, we're sitting right smack in the middle of it. The green line at the top and the red line down below. What is that? The straddle for today's move in the S&P 500, folks, was $20 post the retail sales event. $20 is not a lot. Let's put it that way. It's less than 30 basis points per day. So we're in realized terms are on the floor. Market participants are playing this rotation factor from value to momentum back and forth. But the top end of the expected range based on that $20 straddle is 62.90, 62.50 to the downside. Now I'm going to take it one step forward, okay? So what we're going to do is we're going to look at tomorrow's morning AM settlement monthly expiration open interest. Some additional levels to carry forward. Folks, first level, 6,300. Why did we open there 2 days ago? And that was the effective high for the day. The reason for it is because there is a massive amount of open interest sitting there for those AM settled options at 6,300. The dealers, generally speaking, at net are long those calls. Down below, we have not as large of a size, but a decent size, 1/3 of the size at 62.50 down below. Remember, 62.50 is the today's expected move from the straddle perspective. 62.90 is the upside, and 6,300 is a massive amount of open interest. And so what I'm alluding to is those are the areas that you want to be paying attention to without some sort of a great catalyst. Those could potentially act as relative areas of interest for support resistance identification. Why is that? Well, if the dealers are predominantly short put long call, they buy equities into a drawdown because their short puts are gaining delta. Okay, they're short put long calls. Calls are losing delta, puts are gaining delta into a decline, and vice versa. So they're buying equities um, into a drawdown to decrease their delta hedges from the E-mini S&P's perspective, and they're selling equities into a rally. And so those are the kind of the areas that I wanted to point out to everybody. Again, this is really options related, more technical, but if you're looking for intraday, swing trading type activity, those are really the areas that you want to be paying attention to. Let's talk a little bit about the stocks that might be on the docket here that we want to be paying attention to going forward. So first and foremost, wanted to bring up TSM utilizing our friends technology here at the Chicago Boards of Options Exchange. We're going to look at Live Vol Pro in just a moment, but TSM is up 2.1%, was up significantly higher post the report. We of course know that this is an internationally domiciled company. It's one of the largest chip semiconductor manufacturers in the world, a very important company for everyone to be paying attention to. It's up 2%. It had a tremendous amount of call skew. There was a massive amount of upside calls, activity, and open interest, and it seems like it's kind of having a very difficult time getting through some of the upside resistance zones. Uh, Listen, I'm gonna try to intertwine this point into the commentary that I'm making besides this stock. It's not just this one, but it had an absolutely magnificent run. Let's call it almost 100% off of the April lows. When a stock runs this much into an event, regardless of whether or not it surprises to the upside, of course, if it disappoints, it's usually asking for a big hit. But even if it beats, a stock has a difficult time going substantially higher. So this is from Livol, a SIBO company, just the expected movement versus what is being kind of realized in the market. The median absolute historical move in the stock up or down on earnings, and you could see going back 3 years, the realized movement is predominantly green. That means that it moves to the upside much more often than it moves to the downside. But the median absolute historical realized has been just shy of 4%. So we're way within that boundary. The implied move was about 5%, and that was relatively close to the median implied going back 3 years. And so we're way inside the expected move. And that has been so far the story of this earnings season as it has kicked off. Now, a couple of more here for you, then we'll carry the information forward. IBKR, of course, brokerage company, a competitor of ours, is going to be reporting after the close today. The current implied move for that stock, if you're a stockholder, plot upside and downside levels for the expected move onto your charts. 4.85% up or down. Median implied historically has been 4.15, which is telling us that there is a little bit more expected this time around with a median absolute realized of 4%. The last two announcements, earnings announcements for IBKR, have been wildly divergent. One was a huge beat and a move to the upside, just shy of 9%. That was 2 quarters ago. And then last quarter was the exact opposite move. So this stock is certainly known to move outside of its expected range, just based on what we've seen in the prior 2 quarters. The next one, the big one, I think, that is more technology oriented, even though that it's in the consumer discretionary sector, that would be Netflix, folks. Netflix is expected to move up or down 6.26%. It's well shy of its median implied going back 3 years of 8.4, and it's well shy of the median absolute historical realized of 8.77. So I would keep this one on your radar. I'm curious your thoughts on this stock. Again, I was looking at it with my colleague, Mr. Matt Davison, the other day, and I was just in awe of the fact that this is a stock that is trading at $1,200 plus. I remember seeing it trading in the 100 range, and so that has been obviously an amazing success story so far. Now, I'm gonna try to do my absolute best to kind of intertwine my thoughts and comments into what is happening in the market broadly. Folks, we know that we've run a very long way in a very short period of time. We're up 30% off the lows. We hardly had any pullbacks. There are certain stocks, of course, that have been carrying this market higher. Like an example of that being the financials industry, XLF, for the most traded volume-wise exchange traded product that we generally pay attention to, that the vast majority of the stocks that have reported this week are a part of, has become a number two market cap weight in the S&P 500. I mean, that's how great of a run they've had so far year to date. This is a chart just showing all of the banks on the left-hand side that have reported so far, whether it's Citibank, Wells Fargo, whether it's BlackRock or State Street or Bank of America, Goldman Sachs or Morgan Stanley or PNC or Bank of New York Mellon, whoever it is. This is a 1 month chart, and you can see the percentage returns here on the right. The vertical line is straight through the JP Morgan kicking us off with its earnings announcement, first and foremost, super early in the morning a couple days ago. And what sort of happened to all of these stocks post the event? Folks, when stocks run this much in anticipation of great results, and then those great results come at us, triple beats across the board, top line, bottom line, margins, trading activity, whatever it is. Stocks, even on massive beats, have a difficult time continuing that path higher. It doesn't mean they can't go higher. It just means that there is a lot of good news that are already being priced in. And so I think what we can do is carry this information forward and say it doesn't mean that the stocks that have run a massive amount so far, year to date or quarter to date, cannot go higher. It's just based on the realities that we're observing with some of these stocks. It's very difficult to maintain that pace and that momentum regardless of what the numbers are, even if they beat. Okay. We got 3 minutes to go here. A few thoughts on the liquidity metrics and a couple of caveats that I find just to be very curious. One, going back to our tools from the CME group, the liquidity format tool. So we often look at this going into the quarterly expiration cycles. I always say don't confuse liquidity for volume. Very heavy volume doesn't mean that the market is liquid. It really depends on how many bids and offers are out there and how many bids and offers are out there in size. The bigger the size of bids and offers, the tighter the market between the bid-ask spread, the more liquid it is. Just because something is trading with a tremendous amount of volume doesn't mean that the market is liquid. Oftentimes, it's actually the opposite. Everyone is trying to get out or everyone is trying to get in, producing a substantial amount of volume, overwhelming either the supply side, the bid, or the offer side, right? What this is representative of is the red and green mountains here are representative of the liquidity of E-mini S&P futures as we sit right now, kind of going into this quarterly or monthly expiration cycle for options. And we're pretty good on the liquidity front. And that is a good sign. Okay. We're not seeing a tremendous amount of volume being traded in the S&P 500, whether it's SPY, IVV, or VOO, whether it's E-mini S&Ps on the future side, or it's the options in the SPX or SPY pit. But liquidity is there. And so if the market is moving up and down, at least going into this expiration cycle, we could foresee people probably standing their ground at levels that I've identified a little bit earlier for you going into tomorrow's open. Last comment here as we're wrapping up and closing shop. On the retail front, folks, notice how Albert was talking about the U.S. dollar, talking about the decline and then the recovery. I spent a decent amount of time talking about DXY and my thoughts on that from the very long-term perspective and the short-term perspective in the off-the-chart session. All of that matters when the dollar is down 10% and all of us who are domiciled here in the United States, if we live and breathe, if we work, if we own real estate, if we own assets, we're long a lot of dollars. And when the dollar is down on the quarter 10% in a straight line, it makes it kind of a hard pill to swallow. Here's the reiteration of the idea that I presented. Retail sales. Folks, who is the power spender in the United States of America? It's the high income earners, 80th percentile and upward. Everybody else is kind of keeping pace with the consumer price index effectively in terms of the growth of their spend. Who owns the stock market, folks? Top 1% owns almost 50% of the US market, whether it's single stocks, exchange traded products, or mutual funds. You would say, okay, who owns the rest? Well, if you exclude the top 1% and you just look at the 9% below them, so effectively 90th percentile up to 99th percentile, they own 37% of the stock market. Folks, we're talking about 87% of the stock market owned by the top 10%. Again, who are the spenders and why do the retail sales not roll over? I think it should be pretty obvious when the market is at all-time highs and people are feeling great about their wealth and their wealth trajectory. It's kind of a crazy thing to be betting against the US consumer in this environment. Okay, so those are my thoughts. I think they're kind of coming to fruition with today's numbers. We'll see if 1 month does not trend make, but without a significant correction in the stock market, it's going to be quite difficult to see that massive deterioration in retail sales going forward. And this is very important, Albert, because consumption is 67, almost 70% of the United States GDP. So that stuff matters. I guess eventually, if we do see tariffs, that's going to be affecting things, and that will matter, and that will translate into CPI and PCE and core numbers. But we'll have to wait and see. I was excited to be here. We're a couple minutes over. Let's wrap it up here. Albert, last words to you, sir.
Yeah, I've actually wanted to share one last thing before we go here today. Obviously, keep an eye on the data and stuff like that. But GE had numbers that came out, beat on both, particular strength in their jet engine business, which saw revenues for commercial engines and services up over 30%, and they raised their full year forecast profit and revenues. But the thing I was excited about, Constantine, is a very rare formation that we saw in the chart itself. I believe this is called the very rare Loch Ness Monster formation. As you can see, I pulled this up for us. So an exciting day for GE. We'll see how the day plays out. They had their earnings, looks good, but the Loch Ness Monster formation. Watch out, folks. I hope everyone has a great rest of their day. Constantine, always a pleasure, sir. And we'll see you next time. Take care, everybody.
Take care. Take care.